sales trust, what's the difference between that and Delaware sales trust? When I brought this up with other people,
Yeah,
they seem to confuse those or bring it up.
It happens all the time. Unfortunate acronym, okay? So DST,
Yeah.
Deferred Sales Trust. Delaware Statutory Trust
Okay.
is the other DST that's more commonly known, right? The Deferred Sales Trust, DST, has been around a lot longer than the Delaware Statutory Trust, but it's just not as commonly known. So different things altogether. Delaware Statutory Trust is something that you would invest in mostly in a 1031, but you can invest in them outside of that. But mostly they're in the 1031 context, to where if a lot of times people will name those in their identified properties as a kind of as a backup. They say there's specific properties that they want to buy and they fall through, right? But they don't want to pay the taxes. They have a Delaware as a backup, and it's nothing but a tenant in common investment, to where you are a 0.3% owner of $400 million Amazon facility, right? So those are locked down. I mean, one of the downsides to those is you got no liquidity, right? You don't decide next week, hey, I'm going to sell this and do something else. You're going to get your money when they tell you get your money, right? So I'm not a huge fan of those for that reason. You're just kind of locked up. You don't have any ability to make any changes. They serve their purpose, but once people realize that they don't have to do that, that if they're, and I'll cover this real quick. So another thing that we do with exchanges, we actually can bifurcate it. So, for example, you say, I might want to try an exchange. So we'll do your sale. We'll start it in a 1031 exchange. And as the 45 days is coming up, you might say, I got nothing. Can't find anything I'm okay with. I can rescue that 1031 into the Deferred Sales Trust, okay? This is already in the tax code, right? So section 1031 says the relationship between you as the seller exchanger and the 1031 QI is that of a borrower lender. The QI is the borrower. You're the lender, it's your money, right? So all we do is we formalize that. We say fine, right? We put the promissory note in place and we have it assigned over to the trust, and you still get to defer your taxes. There's 1031 companies that do this for a living that have no idea that that's even an option. And I have conversations with them all the time. But once I show them, I say, listen, I didn't make this up. It's right there in the tax code. They're like, I've done this for 30 years. I've never heard of that. So, and I've got a lot of people that do that. Or some people say, hey, I'm going to sell this and I'm going to do 1031 and I've got $5 million, but I've got one specific property I want to buy, and it's $500,000 that I know I want to buy, but I don't want to do all of it. We can make that one investment, all right, buy it, and then let the rest of it fail. In this case, fail is good, right? Because that means in the 1031, it's rolling into the Deferred Sales Trust. So we take the $4.5 million, still defer the gain on it, and end up doing other things with that, not in real estate. Do that all the time.
And I think, kind of to your point, right, and nothing against any of our CPAs that are in the room tonight. Okay. I'm not looking at you, Michael. I'm just kidding. Is that, no, this scenario happened. So we have a couple of clients, one that we helped them sell their apartment complex downtown. And so I know they use Todd to do a deferred sales trust, the Lawrence's and that. But we have another client right now that we're getting ready to close on their property that's like $6 million or whatever. And so they were talking about doing a 1031, but they were like, we're kind of done buying real estate. So we're trying to look for an option. I was like, hey, I've got a guy that you can call, have a conversation with him. So I tried to tell him a little bit about what a deferred sales trust was. But I said, hey, I'm not a real estate attorney. I don't practice one on television or any of that kind of stuff. I said, but let me, and so they're like, no, my CPA, and they're from California, but they're like, my CPA said that's not possible. There's no such thing. No way. It's not possible. I was like, just do me this favor. Just have a conversation with me, and then let's talk afterwards, right? And so I lined them up. They were here in town. They went and met with Todd, And, then the next day, Jan and I went to dinner with them, and they're like, dang, you know what, you were right. My CPA didn't know about that, until.
Todd
so-
makes us look good.
Yeah, so from that standpoint, but I think it's just, it's great that there's somebody that has this expertise, right?
I
That you can-
spend most
and
of my
you probably get a
days.
lot of calls, right?
Oh,
like
yeah,
that.
I spend my entire
You can't do
day
that.
on the phone with people talking about this, and there's usually tax attorneys and CPAs. And the one that is closed for the 150 million, when we first got that started, he hired a tax advisor, one of these big New York firms, and we got on the call just to talk about it, and I explained to him how it all works. And we weren't in the call 2 minutes, and the New York guy's like, "No, this isn't going to work. You don't want to do this." And the guy that owned the business is no dummy. He's got a $150 million business he built from scratch. He knows a few things. So he said, "Let me get this straight. This has been used for 25 years without any consequences, but in 1 minute you figured out it doesn't work. Am I understanding you?" He said, "You're fired," and hung up the phone, called me right back, said, "I'm going to find somebody else that'll take more than 1 minute to help me figure out how not to pay $40-something million in taxes," right? He's motivated to make sure this works. Found somebody else that was open-minded. We talked about it. He said, "Listen, I've never done this. Let's run through it." He called the guy and said, "Listen, we've been through it. We spent 2 hours on the phone." He told him, "This works." So we closed it. So if you've got a seller, right, that you're working with, or it's you, or it's a partner, whatever, you just have to pick your advisors and see who's really trying to help you and who's just on their, doing their own thing. I've had plenty of people say to their advisors, "Are you paying this tax bill to the IRS?" No. Well, then get on board, because you need to figure out, if you can't get your head around it, we're going to get somebody that can.
I have two more questions. One is, does this only work for long-term capital gains? Can you use short-term?
Use short term. So, give you an example. I recently closed a portfolio of properties right here of 22 restaurants. And my buyer had the real estate under contract, right? But then we found a sale leaseback company that wanted to have this buyer as tenants in all of these properties. So we had it under contract for $36 million for all the real estate, and essentially sold the contract to this sale leaseback company for $41 million. So what we created the installment sale with was the contract. That was the asset, right? So that clearly was short term because it happened all at the same time. But that gain is deferred. Again, sold the contract for that spread for the $5 million, and that's now in a deferred sales trust. And they used that $5 million for the down payment on the operations for those 22 stores. That allowed them to get 100% bank financing, because it was just like they brought $5 million of their own money, which they did, but they brought $5 million tax-free money to invest into those stores. So I've got, as of yesterday, I got my 7th call from that sale leaseback group on other deals they're working, that they want me to talk to buyers and sellers that they're involved with to show them how to do that, because that one made that deal work.
We might know that guy, maybe. Anyway,
I don't
Go ahead,
know if you've
David.
been to Niagara Falls, have you? There's a sign that says point of no return. Right
Yep.
At the top. Where is that for here? So if I have a client that's about to sell, where's the point where they cannot go back?
So usually if we're close to closing to where we've got no contingencies, funding is approved, then we might be there. But my opinion is, if it's not closed, I don't care how many contingencies you don't have, right? Until it's closed. Again, my example, call that title company the week before you close. Say, "I want you to send me my money." Hey, wait a minute. I got 100 things that have to happen before I can do that. We're still operating in that space to where we can make it work. I do get calls all the time. "Hey, we're closing next week. Can we do something?" We'll usually figure something out. I do get calls that I can't help people. I say, hey, I signed yesterday, right? But I haven't got the money yet. It's in the trust account. I said, just go ahead and get the money, because there's not anything you can do.
I understand that on a 1030, was it 1031?
1031.
That you have to set that up ahead of time. And how long does it have to exist before you can utilize that?
So 1031, there's no time limit, right? So
Day
I got a
before.
call as I was walking out of the office to come over here from somebody who's closing tomorrow and wanted to do a 1031. They just decided, I don't know why, last minute. And I said, yes, send over the stuff and we'll get it worked out. So there's no time constraints on that at all.
Okay, I got some bad information then. Somebody told me a few months back, that has to be set up for a while before you can do anything with it. but
100%
Not
false.
true. Good.
Nope. Nope.
Must have been the guy in New York.
Well, if that were the case, if that were the case, I'd be out of the 1031 business, because almost all the ones I get are the day before, 2 days before. Nobody plans ahead.
Can you operate as a qualified intermediary on that, or?
I am one.
Okay,
Yeah,
awesome,
I've got a company that's what we do.
okay.
Yep, do those all the time. Done those for people in here.
Let's say there is a time, or a time comes where I wanna take a large distribution from the trust. What sort of tax mitigation strategies are available at that time?
So go back to the same concept that you only pay tax on what you receive.
Right.
So at that point, if you take a payment, let's say you're gonna take a payment out that's, you've already been paid all your interest that you're due, and you say, hey, I've got an emergency, I need $500,000, okay? That $500,000 is gonna be taxed according to whatever the ratio was at closing between your tax-free basis and your capital gains, okay? Now, there's some things that you can do after the fact to mitigate those taxes, right? There's investments you can make that generate some losses, some depreciation, some other things to offset that gain. We do that a lot. Sometimes there are certain types of income or sales that we can't defer, right? Sometimes we've got accelerated depreciation that creates recapture, right? This can't fix that. Directly, it can't fix it, but afterwards, you can make some investments to offset that to mitigate those taxes. We've got lots of different things we can do. Pretty sophisticated stuff to, again, everybody loves the IRS, but nobody loves them that much. Okay, nobody loves the IRS. I take that back.
Tommy.
Sure. Todd, great job today. It was nice having you on the meetup yesterday. Even though we had you for an hour, there's still a lot to be learned on the deferred sales trust, so I appreciate your time. So going back to deferred sales trust, I realize you don't have to roll that into just real estate. You can do other things. Is there anything that is obviously off limits to roll that money into? Ideally, you would roll that into appreciating assets. That gives you cash flow or something along those lines. But what is just not on the table or just bad ideas?
Okay, so you can invest in anything you want,
Okay.
but should you is really the question, right? So it's more whether they're prudent investments or not. And I've got, true story, we got one of these I did a few months ago, and this guy sold a business and he got $10 million. And he wanted me to put 100% of that in crypto. I said, I'm not gonna do it. He said, but I'm gonna sign I said, I don't care how much paperwork you sign saying that you're accepting that. When it goes in the toilet, right, and this was 5 months ago, you're still gonna say, why'd you let me do that? So I will say, I'm not doing it. I'll say, here's your money, pay your taxes, but I'm not gonna make an investment like that. So there's things you shouldn't do. Can you make that investment? Absolutely. And if he said, hey, I wanna put 5% of my total amount in crypto, I would say that's fine. But I'm not gonna put 80% or 100% or even 50 into something like that.
Do you ever struggle with clients on that note? Like, in some ways, you're kind of gatekeeping their investment ability, like what they can do. Do you ever struggle with getting clients to accept that?
Not really. Most people have, when they've got the kind of money that they can have a structure like this, it's not by mistake, right? They get it. I don't have to tell them that's a dumb idea. They already knows it. So, yeah, will they ask me sometimes just to make sure they're thinking about it right? Yeah, and I'll say, no, let's not do that. But that really doesn't come up that much. Usually folks have money for a reason. And crypto right now is selling a lot of that at huge gains, but I can do this with crypto. I did one in December. This guy in California had 300 million in crypto, and he had it from early on. So essentially, the entire 300 million was a gain. And in California, at 37%, right? That's a $100 and something million tax bill. So he did this. We deferred the gains. Now he's into a million different things. You talk about the opposite of diversified. Crypto is the opposite of diversified. So he went from being in that one thing that he's into all kinds of stuff. He's got hotels and he's got all kinds of stuff. All of it with IRS's money.
Made me think of the next thing. Say you've got appreciated assets like you have a car collection or real estate and crypto. Can you sell it all at once and put it into?
Yeah, or you can sell it at different times. I've got one I'm doing for a guy that's got 72 rental properties, and he's not selling them as a package, right? He's selling them one off, and we're just putting them into the trust as he goes each time. There's no time requirements that you've got to fund the trust all at once or whatever. It just, we've got some that maybe were done years ago, and somebody said, hey, I got something else I'm about to sell. I want to also do that. So yeah, you can do as many things in under whatever timing schedule you want.
It's the ultimate portfolio maximization.
There's no time constraints or anything. It's just whatever your situation allows.
So I think you may have touched on this a little bit, but I kind of want to directly ask. So let's say you're doing the DST into more real estate. Obviously, there's tax benefits and all that with real estate investing. How does that, I assume that doesn't pass through the trust to you, so because you're getting interest income, so how can you take advantage of all that depreciation and stuff?
So what you don't know is I paid him to ask me that question. Because this is where it really gets cool.
Still waiting on the money
I owe you, right? So here's where it gets awesome. So we talked about if you're gonna have your trust make a real estate investment. We're not doing it directly with the trust for a couple of reasons. One is because we can't control that flow coming in, right? If the trust owned a piece of real estate and it sells it, I've got no way to mitigate that. The trust the gain hits the trust, taxes are due, period, right? So that's why we do it through an LLC to where we can control that flow. But here's what's even better. The trust doesn't need depreciation, deductions, anything like that. So in that LLC agreement, I have that LLC throw off all of the good stuff, depreciation, all the deductions to you, right? So you get to take that, and guess what? This interest you're getting off of the trust, what happens when you have depreciation, all the other stuff? You're offsetting that, generating a tax-free income for yourself with those deductions out of the real estate investment.
That's great.
I've got people who've done real estate for 50 years and say, that's the coolest thing I've ever heard. Because it is. But yeah, that's exactly how we do it. Trust doesn't need the deductions. And in that LLC, we're allowed to say who gets it. It's just, again, I didn't make that up. IRS says you can do that. I'm just using their book.
We have a very unique situation we'd like to run by you.
All right.
That's probably not great for the room or beneficial to the room. What's the best way to get in touch with you?
Just send me an email. I got some cards up here somewhere. So anyway, you can just grab one of those. Just shoot me an email or just give me a call. Yep. So it's not appropriate. It's like NC-17 or something or what? strip joint or what?
But Michael, but he does answer his phone actually and returns your call. Jana has him on speed dial if you need him. So. He calls his sister back.
I try to call everybody back.
Immediately.
Yep.
Yeah, you got to have more questions because I don't want Todd to have to use his Forrest Gump, quote.
That's all I have to say about that. Yeah.
Are there any circumstances you know of where this was IRS audit?
Lots of them. Yep. So the structure's been used for 25 years, okay, and it's had individual audits on individual trusts but every one of those that's happened is because somebody's being audited for some other unrelated reason. But while the IRS is there, they say, hey, what's this trust over here? And they bring it in. And every time it's been audited, there's been a no change ruling. No change means nothing to see here, right? And in addition to those, the IRS has come in for a specific visit to talk about the things I described to make sure we're not having any trap doors dropping stuff offshore. They do that about every 5 years. They come in and say, hey, have you changed anything? Added any, fancy, shiny things to it? Nope, plain vanilla, same we always had. I said, okay, we'll see you again in a few years. So yes, they've absolutely reviewed it.
That was for my CPA.
Yeah, well, and here's the deal, and you're gonna have CPAs, and I talk to them every day, that, and it's human nature. Something you don't understand is automatically bad, right? We're all like that. But if we're gonna do what's best for our clients, whether we're attorneys or CPAs, whatever, we at least need to admit that we don't know something, right? Because nobody likes to say, well, I've never heard of that. Well, because they think they're being paid to know everything, right? Well, I don't know much of anything, so I'm quick to say, I have no idea what you're talking about, but I'm a lifetime learner, so let's dig in and figure it out. And once they do, they're like, hey, that's pretty cool, I never thought of that, but yeah, that works, okay? And the easiest way to kind of boil that down is, if it doesn't work, that means that the installment sale, which has been in the tax code for almost 100 years, has to be taken out, because that's all it's based on. We're not doing anything that hasn't been done for 100 years. Now, we're adding a twist to it, but that doesn't change the effectiveness of it at all. It just makes it more desirable. Yep.
Can you collateralize a loan with this?
So here's the deal. Your note is your asset, right? There's anti-pledging rules. Now that note is on your balance sheet. The bank can see it. You're owed $5 million, whatever it is, but you can't monetize that. You can't pledge that to the bank for a loan. That's constructive receipt. IRS says that triggers the gains. But here's what you can do. If you're going to try to leverage that, you have the trust invest in this other LLC. You have that LLC use that money as a down payment. The LLC borrows the rest from the bank, right? So you're leveraging that money. Not at all the same thing as pledging that note, because you're not. That's just a straight investment. So you get to leverage it that way. So you end up with the same thing. You just do it a little bit different way. So no, you cannot pledge that note. It is yours. You can do with it what you want, but the minute you pledge it for a loan to the bank, it triggers the taxes. So obviously we avoid that. And there's been a structure out there they called the monetized installment sale. That's what it does. It kind of creates this note, but then it says, we're going to find somebody, we've got this captive bank that's going to loan you for a hefty fee the money against that note. So now you have the money in your bank account. And when those came out, IRS is going to just, they already know that doesn't work, but they're going to make it official. Last year they made it official. They said, listen, that never worked. That's not going to work. Stop doing that. So that's for that reason, the anti-pledging. You can't pledge your note, get the cash. It's the same thing as you got the cash in the first place. Yeah. But you do have that note. If you're going to get a bank loan, say, bank, I'm owed this money. Here's my note. Here's my income from it. You absolutely get credit for all of that. Yep. You just have to stop short of actually having them take the note as collateral.
All right, other questions? Have we missed anything, Todd, yet?
I don't think so.
We got it.
I think we're good.
All our different scenarios, things like that.
Was
So,
this valuable, guys?
yeah, so